Welcome back to The Deep Dive, where we cut through the noise of corporate reports to get you the insights that actually matter.
Today, we are jumping into Harrow Inc. That's ticker HROW, and their Q3 2025 earnings call.
And this one was a big one. The call was pre-market November 11th, and it really set the tone for the day. Management came out swinging, just incredibly bullish.
Oh, absolutely. And the market responded instantly. The stock just took off.
It did. It surged about, 13.5% on heavy volume?
Yeah.
But that creates a puzzle, right? Because if you just glanced at the headlines, you'd see they actually missed just slightly on top-line revenue.
Right.
So our mission today is to figure that out for you. We're going to find those 2 or 3 critical data points that made investors completely ignore that small miss and send the stock flying.
And it really all boils down to one thing. Profitability.
Right.
This was just a profoundly solid quarter for them, all about massive operating leverage and, maybe most importantly, swinging to actual GAAP profitability.
Okay, let's start with those headline numbers. Revenue came in at $71.6 million.
Mm-hmm. And consensus was looking for $73.7 million. So, on the surface, a miss.
So why the euphoria?
Because the bottom line delivered a knockout blow. Their core non-GAAP EPS, that's the adjusted number that gives you a cleaner look at operations, it landed between 33 and 35 cents.
And the street was expecting.
The consensus range was down between 24 and 29 cents. So we're talking a beat of up to 30%. It was a massive signal to the market that the model is working. It's really throwing off cash now.
And that margin improvement, that's the proof.
Yeah.
Gross margin was incredibly strong at 75.3%.
And their core gross margin, if you strip out amortization, was even higher at 81%. I mean, that's just fantastic.
Which led to some pretty staggering growth in the profitability metrics.
Well, just look at adjusted EBITDA. It more than doubled. They pulled in $22.7 million, up from just $8.8 million a year ago.
And the big one, the swing to GAAP net income. That was that hen.
From a loss of $4.2 million last year to a positive $1 million. That's the transition the market was waiting for.
That's the moment that confirms the whole story we've been watching, that the operating leverage thesis is finally, real.
And they demonstrated it so clearly on the call. They confirmed that operating expenses, their OPEX, stayed relatively stable from the last quarter.
Even as revenue jumped 12% sequentially and 45% over last year.
Exactly.
Okay, let's unpack that. For you listening, why is a company growing that fast with flat expenses? Why is that the holy grail for a specialty pharma business?
Well, it's the platform model in action. You spend all this money up front on your sales force, your distribution, all that infrastructure.
Right. Those are your fixed costs.
Those costs are largely fixed. So once you have successful products like VEVYE and IHEEZO really hitting their stride, every new dollar of revenue you bring in, well, most of it just drops straight to the bottom line. Q3 proved they've hit that critical mass.
So the engine is running efficiently, and it looks like they also just refilled the gas tank.
Let's talk about that capital structure move they made.
Yeah, that was a really smart move. The $250 million senior notes offering due in 2030. They used that to refinance their older high coupon debt that was coming due in 2027.
So even though they have what you'd call high balance sheet leverage, a lot of debt, this move is a huge de-risker.
It's priceless in this environment. Pushing a debt wall out by 3 years, it just extends their growth runway. It gives them all this breathing room to hit those ambitious 2027 targets without any pressure. They basically bought themselves time.
And the proof that the model is working, the business generated about $16 million in cash from operations in one quarter.
Right. And that financial strength is what gave them the confidence to really push on the thing the market cared about most, securing long-term access for VEVYE.
Yeah, the VEVYE story has totally shifted, hasn't it? It's not about just getting scripts anymore.
No, the narrative is now all about securing that commercial payment access for durable, high-margin growth. So VEVYE, their dry eye drug, had a record quarter, $22.6 million in revenue, up 22%. But the real game changer wasn't the volume.
Not at all. It was the access win for January 1st, 2026. They announced signed agreements with several huge national payers, including the single largest PBM in the U.S.
Okay, let's stop there. For everyone listening, what is a PBM and why is getting preferred status with the biggest one such a massive deal for a drug like this?
A PBM, a pharmacy benefit manager, is the gatekeeper. They manage drug benefits for insurers. They decide which drugs get covered and how easily. Getting preferred status means doctors can prescribe VEVYE knowing it's covered for millions of patients with commercial insurance.
It's like unlocking a door.
It is,
Okay.
and it completely flips the financials for the drug. Management said this win will cause the ratio of covered scripts versus cash pay scripts to totally flip.
And that's all about the ASP, the average selling price.
Exactly. They admitted the ASP, what they actually get per unit, dipped a little, less than 10% in Q3. And that's because they had a lot of cash pay patients who need discounts.
But now
They'll shift to all these insured patients with higher stable reimbursement rates. The mix shift should stabilize and maybe even increase their net revenue per unit. That's the fuel for their margin for the next few years. That's why the stock popped.
And you could just hear the confidence in their voices. They said refill rates for commercially covered patients are, quote, extraordinary.
Yeah, achieving nearly a full year of therapy on average. That's sticky. That's a high-quality product.
And that confidence is already turning into action. They're adding 10 new sales territories immediately.
And aiming for about 100 total by mid-2026, all focused on these newly covered markets. It's a very targeted expansion.
Okay, shifting gears. IHEEZO, their perioperative drug, also had a great quarter.
$21.9 million in revenue, up 20% sequentially, which is impressive because Q3 is usually a bit slow for elective procedures. They're expecting a record Q4 for IHEEZO.
And we also got an update on the Trison's relaunch. This one is important because it gets them into the huge ocular inflammation market.
Right. Revenue grew 33% to $6.9 million. And they made a really interesting strategic choice here. They actually lowered the price.
From over $900, right?
Yeah, they brought it down from $944 to compete better. Competitors are about 20 to 25% lower. They believe that making it more competitive on price, plus their patient assistance program, is already driving a ton of new adoption. It's a volume play.
Okay, and we have to flag the compounding business. ImprimisRx, stable revenue at around $20 million. But there's a headwind there.
A near-term one, yeah. An inventory shortage in October that they think will hit Q4 revenue for that segment by about $4 to $6 million.
A necessary note, but it felt like it was totally overshadowed by the big strategic news.
Oh, completely. The agreement to acquire Melt Pharmaceuticals, this is the long-term story.
It's transformative.
Yeah.
It's not just about eye drops anymore. This moves them into the massive procedural space.
Their lead candidate, Melt 300, is positioned as a needle-free, non-opioid sedation product. It already showed in phase 3 that it was superior to midazolam, which is the current standard.
And the vision here is?
Yeah.
It's huge. Management is talking about enabling opioid IV and drop-free cataract surgery.
Think about that. No post-op eye drops, no IVs, no risky opioids during the procedure.
For the nearly 5 million cataract surgeries in the U.S. every year, it turns them from a drug company into a surgical solutions provider.
The timeline is aggressive. They're targeting an NDA filing in the first half of 2027 with a launch in 2028. And because it has international patents, this could be their first big global product.
Wow. Okay, let's quickly touch on guidance. They updated their full year 2025 revenue to a range of $270 to $280 million.
Which the market actually saw as a positive. It felt disciplined. You know, a conservative, achievable range that still represents over 40% year-over-year growth. They're focused on profitable execution, not just chasing revenue.
And they were upfront about the other headwinds, like that ImprimisRx inventory issue and the ongoing dispute with the California Board of Pharmacy.
But again, none of that mattered to investors on the day. The focus was so clearly on the EPS beat, the de-risking of VEVYE, and the huge long-term story that the Melt acquisition adds.
The conviction is there now. That's why the stock moved.
Right. Which brings us to our final segment where we try to turn all this knowledge into a little strategy.
This is Talk Tickers. And a reminder, this is not financial advice, and you should not take it as such.
Okay, so with the board set like this, strong confidence in VEVYE, proof of the operating model, the trade idea has to be leveraged, and it has to look out over a few years.
Agreed. The market now knows the engine works. 2026 is when we see if the profitability accelerator, that ASP flip for VEVYE, really kicks in.
That's the catalyst. That shift to preferred commercial status fundamentally changes the quality of their growth.
So the pitch is this. You could look at purchasing long-term, highly leveraged call options. Lee CPS for long-term equity anticipation securities.
Dated for, say, early 2028. You're making a bet that the ASP stabilization from VEVYE plus the profit from the rest of the portfolio will accelerate their earnings way beyond what anyone is projecting right now.
The thesis is that Q3 proved the model is scalable. The 2026 coverage wins provide the fuel, and that allows them to hit or even beat their big target, that $250 million quarterly revenue number, by the end of 2027.
It's a bet on scaled, durable earnings power, not just top-line growth.
And that's really the ultimate takeaway here, isn't it? Harrow's story is no longer about proving they have good products. It's about proving they can build a durable, scaled, and highly profitable earnings machine.
They are absolutely moving into their second chapter. But that second chapter is all about flawless execution, which brings us to our final thought to leave you with.
Right. They're expanding their sales force rapidly for VEVYE, and they have this huge, complex melt integration coming up.
So the question is, what specific steps does management have to take in the next year to make sure those new sales territories and that melt pipeline deliver immediate ROI and don't just add a bunch of weight back onto their now stable OpEx base?
That execution is the hinge for the entire multi-year bull case. Thank you for joining us for this deep dive into Harrow's Q3 2025 earnings.
We'll catch you next time.